October 19th, 1987 started like any other Monday on Wall Street, but by the time the closing bell rang, the stock market had experienced the worst single-day crash in history. The Dow Jones Industrial Average fell 508 points, a 22.6% decline in just one trading session. Over $500 billion in market value evaporated in a matter of hours. This wasn't just an American problem. Markets around the world collapsed simultaneously in what became the first truly global financial crisis. Let me show you exactly what happened, why it happened, and what it means for today. The crash didn't come out of nowhere, even though it felt that way to most people. The stock market had been on an incredible run. From August 1982 to August 1987, the Dow Jones climbed from 776 points to 2,722 points. That's a gain of 250% in 5 years. Stock markets around the world had seen similar explosive growth. The 19 largest markets globally had risen an average of 296% during this period. Money was pouring into stocks. Corporate takeovers and leveraged buyouts dominated the headlines. Companies were using junk bonds to finance acquisitions, borrowing enormous sums to buy competitors. Everyone believed the party would continue forever, but cracks were starting to show. In early October 1987, the market began wobbling. On October 14th, the House Ways and Means Committee introduced a bill to eliminate certain tax benefits for corporate mergers. This spooked investors who had been profiting from the merger mania. On Thursday, October 15th, the market dropped. On Friday, October 16th, it fell another 4.6%. That same Friday, a massive storm hit London, forcing stock markets there to close unexpectedly. When they reopened, panic had already set in across Europe. Then came Monday. The Asian markets opened first, and Hong Kong's Hang Seng Index immediately plunged. The selling spread to Singapore, Australia, and Japan. By the time European markets opened, fear was everywhere. London's FTSE 100 fell 14% in a single day. When Wall Street opened on October 19th, the carnage accelerated. Within the first hour of trading, it was clear this wasn't a normal down day. This was a full-blown panic. Here's what made Black Monday so devastating. When the New York Stock Exchange opened, there was an enormous imbalance between sell orders and buy orders. Everyone wanted to sell. Almost nobody wanted to buy. Under normal circumstances, market makers would step in to provide liquidity, buying stocks to stabilize prices. But the volume was so massive that 95 stocks in the S&P 500 and 11 of the 30 Dow Jones stocks couldn't even open on time. Trading was delayed because specialists couldn't handle the flood of sell orders. Meanwhile, the futures market opened on time with heavy selling. This created a gap between stock prices and futures prices that triggered something called index arbitrage. Traders saw an opportunity to profit from the price difference, so they sold stocks and bought futures, or vice versa. This automated trading added massive downward pressure. Computer programs that had been designed to protect investors were now accelerating the crash. The role of computerized trading cannot be overstated. By 1987, a new strategy called portfolio insurance had become popular among institutional investors. The idea was simple. If stock prices started falling, computer programs would automatically sell stocks or stock index futures to limit losses. It was supposed to be a safety net, but on Black Monday, it became a death spiral. As prices fell, portfolio insurance programs triggered massive sell orders. Those sell orders pushed prices lower. Lower prices triggered more automated selling. The cycle fed on itself. Within hours, the Dow Jones had fallen from 2,246 points at the open to 1,738 points at the close. That 508-point drop represented a 22.6% decline, the largest single-day percentage loss in stock market history. It beat even the worst day of the 1929 crash, which saw a 12.8% drop. The S&P 500 fell 20.4%. A record 604 million shares traded hands, 3 times the normal daily volume. Phone lines to brokers were jammed. Millions of people couldn't reach their brokers to place orders. Some people who did get through couldn't sell because there were no buyers at any reasonable price. The panic wasn't limited to the United States. By October 23rd, London's FTSE 100 had fallen 25% from its pre-crash level. Japan's Nikkei dropped 13.2%. New Zealand's stock market, in the most extreme case, fell 60%. Markets in Hong Kong, Frankfurt, Amsterdam, Mexico City, and Sydney all experienced devastating losses. This was the moment the world learned just how interconnected global financial markets had become. A crash that started in one region spread instantly across time zones, carried by fear and automated trading systems. The psychological impact was profound. Investors who had watched their portfolios grow for 5 straight years saw their wealth evaporate in a single day. People called their brokers in tears. Some investors and traders, unable to cope with massive losses, became severely distressed. The media amplified the panic with wall-to-wall coverage, showing traders on the floor of the exchange in chaos. For the first time, a major market crash was broadcast live on television around the world. People in Europe and Asia could watch Wall Street collapse in real time, which only intensified the selling in their own markets. But here's what makes Black Monday different from 1929 or 2008. The economy didn't collapse. There was no Great Depression. There wasn't even a recession. The Federal Reserve acted decisively to prevent the crash from spreading to the broader economy. On October 20th, the day after Black Monday, Fed Chairman Alan Greenspan issued a statement affirming the Fed's readiness to provide liquidity to support the financial system. Behind the scenes, the Fed pressured banks to keep lending to securities firms on normal terms, even though those loans looked risky. The 10 largest New York banks nearly doubled their lending to securities firms during the week of the crash. This intervention worked. By providing liquidity and cutting interest rates, the Fed prevented a credit freeze. Banks didn't fail. The financial system stayed functional. And remarkably, the stock market began recovering almost immediately. Within 3 trading days, the Dow had surged 288 points, recovering some of the losses. By September 1989, less than 2 years after the crash, the stock market had regained all of its losses and resumed climbing. The bull market of the 1990s was underway. So what actually caused Black Monday? Economists and market analysts have debated this for decades, and there's no single answer. Several factors came together. First, the market was overvalued. After 5 years of explosive growth, stock prices had gotten ahead of economic fundamentals. A correction was overdue. Second, rising interest rates and inflation concerns made investors nervous. The Federal Reserve had been tightening monetary policy, which typically pressures stock prices. Third, a weakening dollar and rising trade deficits created economic uncertainty. Fourth, tensions with Iran added to the anxiety. Just days before Black Monday, U.S. warships shelled Iranian oil platforms in response to a missile attack. Oil prices were volatile. Fifth, the proposed tax changes for corporate mergers spooked investors who had profited from the merger boom. And sixth, the great storm that closed London markets on October 16th created additional uncertainty and disrupted normal trading patterns. But the technical factors were probably most important. Portfolio insurance and computerized trading turned what might have been a normal market correction into a crash. When prices started falling, automated systems kicked in with massive sell orders. This overwhelmed the market's ability to absorb the selling. Index arbitrage between stocks and futures created additional pressure, and the sheer speed of the decline prevented rational decision-making. Fear took over, and selling begat more selling. The crash revealed serious structural problems in how markets functioned. Trading systems couldn't handle the volume. Communication broke down as phone lines jammed. Market makers couldn't provide liquidity. Prices became disconnected from any rational valuation as panic drove decisions. Regulators realized that the market infrastructure wasn't equipped for the computerized, globalized trading environment that had emerged. This led to important reforms. In the aftermath of Black Monday, stock exchanges worldwide implemented circuit breakers. These are mechanisms that temporarily halt trading if major indices decline by a specified percentage. The idea is to give everyone time to calm down and prevent automated selling from spiraling out of control. As of 2019, if the S&P 500 falls more than 7%, trading halts for 15 minutes. At 13%, another halt. At 20%, trading stops for the day. These circuit breakers were directly inspired by Black Monday. Regulators also tightened oversight of program trading and portfolio insurance. They improved coordination between stock markets and futures markets. They enhanced the capacity of trading systems to handle high volumes. And they developed better tools for providing liquidity during crises. The Federal Reserve's response to Black Monday established a precedent that central banks would act aggressively to prevent market crashes from becoming economic catastrophes. This became known as the Greenspan put, the expectation that the Federal Reserve would step in to support markets in a crisis. But has the system really changed? Many of the same vulnerabilities that caused Black Monday still exist today. We still have automated trading, now even faster and more sophisticated. High-frequency trading algorithms can execute millions of trades per second. We still have complex derivatives and interconnected global markets. We still have moments of irrational exuberance where prices get disconnected from fundamentals. And we still have the potential for panic to override rational decision-making. The 2008 financial crisis and the 2020 COVID crash showed that markets can still experience sudden, severe declines. The circuit breakers helped in both cases, slowing the panic, but they didn't prevent massive losses. In March 2020, circuit breakers were triggered multiple times as the pandemic sent markets plunging. The system worked better than it would have without circuit breakers, but the fundamental vulnerability remains. Black Monday teaches several lessons. First, markets don't go up forever. No matter how strong a bull market seems, corrections happen. Second, automated trading and complex strategies can amplify volatility rather than reduce it. Third, global markets are deeply interconnected. A crisis in one region spreads instantly. Fourth, central bank intervention can prevent market crashes from destroying the economy, but it requires quick, decisive action. And fifth, overvaluation always corrects eventually. The only question is whether the correction is gradual or catastrophic. For individual investors, Black Monday is a reminder of the importance of diversification and not panicking during crashes. People who held their stocks through Black Monday and the recovery that followed ended up fine. Those who sold at the bottom locked in their losses. The market recovered within 2 years and then soared through the 1990s. Timing the market is nearly impossible. Staying invested through volatility is usually the better strategy. Black Monday remains the worst single-day percentage decline in stock market history. 22.6% in one day. Over $500 billion evaporated. Markets around the world crashed simultaneously. Yet the economy kept growing. The stock market recovered in less than 2 years. The bull market of the 1990s became the longest in history. Black Monday was terrifying in the moment, but it turned out to be a blip in the long-term trajectory of markets. The lesson isn't that crashes don't matter. The lesson is that they're survivable if the financial system stays functional and policymakers respond appropriately.